Because crypto assets have proved to be so volatile, they are unlikely to grow into money substitutes and become a viable means to pay for transactions. However, stablecoins, a subset of that sector, which purport to maintain a stable value, have greater capacity to function as privately issued money. For this reason, they pose specific and well-understood risks, similar to other types of money-like assets. History has shown that money-like assets are subject to runs that can threaten financial stability. Stablecoins linked to the dollar are of particular interest to the Federal Reserve. As Chair Powell said the other day, a central bank is and always will be the main source of trust behind money. Stablecoins borrow that trust, so we have an abiding interest in a strong federal prudential framework for their use. Over time, stablecoins could pose a risk to financial stability, and it is important to get the regulatory framework right before they do. Here, too, the Fed is working with other regulatory agencies. The President's Working Group report on stablecoins that came out about a year ago called upon Congress to take the necessary action to ensure that stablecoins, particularly those that serve as a means of payment, are subject to prudential regulation. Congress should take action to provide a strong federal framework for prudential oversight, and regulators must also use their existing authorities. Let me turn now to the issue of tokenized banking liabilities. We are seeing banks explore a variety of different models to issue dollar-denominated tokens on distributed ledger technologies. The proposals range from issuance of tokens on private controlled networks to facilitate payments within or among banks, to proposals that explore issuance of freely circulating tokens on open, permissionless networks. As banks explore different options to tap into the potential of the technology, it is important to identify and assess the novel risks inherent in those models and whether those risks are surmountable. For instance, with some models that are being explored, the bank may not be able to track who is holding its tokenized liability, or whether its token is being used in risky or illegal activities. While there is work underway on technical solutions for managing these risks, it remains an open question whether banks can engage in such arrangements in a manner consistent with safe and sound banking and in compliance with relevant law. Given these open questions, banks looking to experiment with these new technologies should do so only in a controlled and limited manner. As banks experiment, I invite them to engage with their regulators early and often, discuss the benefits and risks associated with these new use cases, ensuring that they are consistent with banking activities being conducted in a safe, sound, and legally permissible manner.